So welcome all to today's financial planning webinar on the topic, crafting a roadmap towards your financial goals. Today on this journey, we'll be exploring more about the importance of financial planning. So the question is, how do we piece all the puzzles that we have? Because we can imagine as a financial future as a vast and complex puzzle. So your dreams, your goals will be a unique puzzle in that. So here we are with the financial planning. So we'll be helping you out in placing the right piece at the right place to figure out your financial goals. It's about building a path towards your dreams, securing your family's future, and ultimately achieving your definition of financial success. So a few of you might ask, it's like, does financial planning truly make you wealthier? So the answer is actually yes. Through proper decision making, disciplined savings, and informed investment strategies, financial planning can help you transform your financial landscape towards your financial objectives. And today we'll be guiding you, and thank you for the opportunity to craft your own roadmap towards the financial success. I am Vinayak Kumar, financial planner at ithought, and today I also have Janaki Raman. So we'll be taking you through the presentation. So planning your finances allows you to write your own story during your retirement. Every investor, every client has a different financial story and a different financial goal. Planning your finances will be making you and getting you a better clarity in how you will achieve your financial goals and how you will be easily achieving your retirement target. So there may be a lot of questions you ponder about. What does financial planning mean to you? How much should be saving per month towards reaching a target goal? And are you investing towards your financial goals? Because a lot of people save and invest, but what they have to do is they have to rank down their priority goals from top down to low, and they have to start building the wealth towards their financial goals. And also, are you prepared for any financial setback? So what usually happens is if there is any contingency or any emergency expense that arises, people usually go and touch on their investments. What we'll be focusing on will be building a separate contingency reserve or emergency reserve in the upcoming slides. So financial planning is simple. Getting a few things would pay off. Having a budget. So what would be having a budget mean? So when you receive a monthly salary, for example, suppose 100 rupees, based on your needs and wants, you need to figure out what would be the saving potential that you can rise upon. So based on that, once you start fixing a savings potential rate, easily you'll be able to save and you'll be able to invest towards your financial goals, ensuring yourself. Before starting any investments, it's very important to insure yourself. There are a lot of insurance policies in the market, and about insurance, we have separate comprehensive slides ahead. So being tax efficient, it's not easy and possible to avoid taxes, right? But with proper tax planning and tax management, it's easy to reduce the tax liability by choosing efficient tax regimes and also by making use of the available tax deductions in the market. Diversifying the savings. So as the saying goes, not putting all your eggs in one basket. So a little bit of everything is needed for your asset allocation, and asset allocation of every client would be different because the financial goals would be different and your financial obligations and needs would be different. Managing your loans well. So having a loan is not a bad thing, but making the most out of it and using a proper repayment strategy can give you a proper relief so that you are not with this obligation for a lifetime. And there are a lot of ways to do the prepayment of loans, and we'll cover it in the upcoming slides. And also one would be planning for your future. So for example, you're walking through the road, talking on the phone. Suddenly your phone drops and screen shatters, and you realize that the phone is unusable and needs to be replaced immediately. What would you do in this current situation? So maybe this situation would be in your month and you won't have enough savings. Usually some people will go and touch the investments. So what I would recommend is it's very important to create an emergency reserve. What would be an emergency reserve? Emergency reserve would be a separate fund so that if any emergency or contingency arises, you can go and withdraw from that reserve. So what would be an ideal emergency reserve? Your total 6 months of your expenses or 12 months of your expenses can be reserved and parked into something called as short-term debt or a fixed deposit. So why I would say something like a short-term debt? Because in FD, once you start building the corpus, Whatever interest is there, it's taxed based on the TDS. Interest is taxed up as per the TDS. But as you maintain and reserve a short-term debt instrument, even if you sell your portion out of it, then only the capital gain comes in the picture. So the taxation part, short-term debt would be a better investment avenue compared to the FD. So few people might have already a lot of loan obligations and debt obligations. Sure, should you take a loan or not? It would be different for different people. And at some point of view, taking a loan to buy a depreciating asset is not advisable. So, okay, for example, as you see on the screen, there's a car loan that we take for 12 lakhs. There are two scenarios. One would be 8 years and one would be 5 years. And the interest rate is also similar, 8.5% each for both the scenarios. But by seeing the EMI of 17,200 compared to the 24,600 EMI for 5 years, people tend to go for the 8 years duration for the car loan purchase. But as you make the calculations and figure out the interest payable, it's around 4.5 lakhs for the 8 years tenure, and comparatively only 2.7 lakhs for the 5 years tenure. So there's a 1.8 lakhs you can save in interest if you go for a lower term. So taking a car loan is not advisable, but if you go for a car purchase, it's advised to go for a lower tenure so that you can save the interest. Yeah. So as you see, it's like a lot of people go and buy a asset such as a traditional asset called as home loan, and in that most four out of 5 people finance it through a loan. So we can see a case study and we can see how to reduce the debt burden and how not to commit for it for our next lifetime. Because a person starting from my age, maybe I'm just 20, 25 years old, in my early 20s. So if I go and commit into something like a home loan for the next 25 years, I'll be paying around all my earnings into this loan. So for example, I'll take a home loan for 50 lakhs. Interest would be somewhere around 9%. And the tenure, let's assume it to be 25 years. The total monthly EMI would be somewhere around 42,000 for next 25 years. And the total interest paid would be somewhere around 76 lakhs. That is 1.5 times of the total principal. So how can we repay it and make use of this home loan in a better way? The answer is prepayment. So for a year, you pay around 12 EMIs per year, right? So in that case, what we can do is we can pay is one additional EMI. Just paying one extra EMI, you can bring down the 25 years tenure to 20 years. And the interest can be only paid, that is would be 57 lakhs. So you're saving around, so you're paying around somewhere around 19 lakhs. So in this case, what would be the scenario is you are following your 12 EMIs per year. I'm just asking you to add on one more EMI so that your time saved would be 5 years and the total interest saved would be 19 lakhs. There's one more additional case that's more interesting. So everyone will receive some hike, right, in their pay. So in that, what I would recommend is 5% of your hike you can transform into your EMI and you can add it on and you can pay higher EMIs every year. So that first year the EMI would be 42,000. Next year, I would top it off with another 5%. That would be 4,400. And the third year, so on, it would be 46,300. As on years go by, I would be able to repay the entire home loan of 25 years by just 13 years. So the total interest paid here would be somewhere around 41 lakhs. So what is the benefit? The time saved would be somewhere around 12 years and the total interest saved would be somewhere around 35 lakhs. There are a lot of strategies that you can use for repaying your home loan and other loans. And one more strategy I would like to say is something like going for paying off your high interest loan first and keeping your low interest rate EMI for the upcoming years, so that what you will do is you can reduce your debt outflow and reduce the debt burden. So creating a financial plan is easy. Just charting down a monthly budget and figuring out what is your savings potential and investing that savings potential towards your financial goals and maintaining an emergency reserve. That would be one of the important things starting your financial journey. Maintaining an emergency reserve, a separate medical reserve that would cover your emergency or contingency expenses, one thing. And if you have any taxes, you can plan to prepay your taxes and plan to prepay your home loan and other loans. And apart from that, keeping your taxes in order. Obviously, it can't be avoided, but by using tax planning and debt management exercise, you can try to reduce your tax liability. And obviously, doing your human life value calculation and figuring out if you're underinsured, what would be the top up insured that is required, and so that your risk management side is covered. And obviously, we have to plan for your short and medium term goals. For the next part of the insurance, your first line of defense, I would call out Janaki Raman to continue.
Thank you, Vinay. That was a good intro on financial planning. Now we look at a very, very important part of our financial lives, which is insurance. Now, before I begin with insurance, I would like to clear two concepts up. One is insurance and the other is investments. See, these two things are polar opposites. Insurance is only for providing protection. You don't do insurance to grow your wealth. You do insurance so that you're protected against any kind of emergencies. Health emergencies, you have health insurance. Life emergencies, you have a term insurance, not a money back policy or an endowment policy. Now, for an investments, we have a separate session along with the presentation as well, where we'll dig much deeper into what kind of investments are available in the market. Now, if it is insurance, what kind of insurance does a person need? We'll look at it in the following slides. Next. Okay. Now, this is the agenda on the insurance. Okay, we'll talk about what are the myths that is prevailing around insurance. So the first myth that I see a lot of young professionals, especially doctors, lawyers, people who are working in the IT field, do is young and healthy people usually don't take insurance. They are satisfied with the insurance that their office provides. While the office insurance is okay, I'm not saying that you shouldn't go for it. What I would recommend is that always have a personal health policy in place. Now, we all know how COVID was a very big scare. During that phase of our lives, a lot of people lost their jobs as well. People in IT sectors are more prone to losing their jobs as well. Now, at that time, your office health insurance won't continue. That is why a health insurance policy is very essential. Now, you might say that I have a saving of 5 lakh or 7 lakhs. Why do I need a health insurance? This is precisely why you need health insurance, because you don't want your savings to be depleted. You want your savings to remain as savings and your insurance to act as a protection. Now, the second myth being life and health insurance through my employer is sufficient. Like I answered in the previous thing, while life and health insurance through your employer might be sufficient enough, if in the case of a job loss, you would lose all these covers and whatever the benefit that you have accumulated through these health insurance as well. So it's always good to have a good individual policy in place. Now, the third thing, insurance is for investment purpose. Now, this is where a lot of things does go haywire, because insurance is never for investment. Insurance should be only for protection and protection only. For investments, we have other products that are linked to the market or government schemes that are available, which provide much better schemes and are much better at beating inflation as well. Life insurance is for saving taxes. While life insurance does help you save taxes, life insurance is primarily for providing your nominees a good peace of mind after you. That is what life insurance or term insurance is for. It provides an additional benefit of protecting you. It provides an additional benefit of saving taxes as well. But the number one thing that you should take a life insurance, a term insurance, is to provide financial security to your family members after you. We'll go on to the next slide. Okay. Now, before buying an insurance policy, a lot of people usually go for insurance policies that are recommended by LIC agents or by their family members, and they blindly buy it. But I say there are a few key things that you should look at before you buy a health insurance policy. First, the policy number. Always keep this handy, because the policy number and the policy will be the first thing that an insurance agent asks when you go for a claim. Second, what is covered. We look about it a lot more. In term insurance, this is not as important, but in health insurance, this is very, very important, because health insurance will kind of differ from person to person and the existing conditions that you have. So we look at it in a lot more detail. Third is the tenure of the cover. Health insurance is usually for a period of 1 year or maximum 2 or 3 years. Whereas life insurance, it might be for a period of 30 years, 40 years, until you go to 60, until you're 65, things like that. Premium amount. Now, this is a very, very important thing to look at, because the premium will vary based on your age, based on the number of additional riders you take. There are some riders where it does make a difference, and there are some riders where it doesn't. We look about it a lot more. And terms and conditions. See, if you're a person who does have an existing illness, it makes sense that you disclose it and you read the policy's terms and conditions as well. Next. Okay. Why do you need insurance, and why do you need term insurance in particular? Okay, now let's take an example. Ram is 40 years old. He's working in an IT company, and he has a wife and has a kid as well, and he has two parents who are dependent on him. Ram is the sole member of his family, and when he's traveling, he gets into an accident. He gets into an accident, and he ends up losing his life and passing away. Now, what kind of insurance does Ram need in this case? Ram needs only one type of insurance in this case, and that is term insurance. To be clear, there is a difference between term insurance and life insurance. What is the difference? Life insurance or money back policies or endowment policies are primarily insurance come investment saving products. Meaning, let's say I pay an LIC policy for the next 10 years. At the end of the 10th year or at the beginning of the 11th year, I get an amount from LIC, a money back amount or an endowment amount from LIC. Now, in a term insurance, this is where there is a stark contrast, because this doesn't happen. In a term insurance, what happens is that you are covered for a particular amount of time. Let's say 20 years or 30 years. Let's say Ram takes it at 40 years. He's covered till 65. Now he'll keep on paying premiums. If something happens to him, that is in the case of death, his family will receive a much larger amount than what an LIC would pay. An LIC policy for the same amount of premium would be worth around 10 lakhs. But a term insurance would be worth in multiple crores, maybe even 1.5 crores or 2 crores. This is where insurance comes in, because insurance is just meant for protecting you and your family after you. Now, for investments, we have better products such as mutual funds, which will help you earn a much higher return. So what type of life insurance a person needs? There's only one type of life insurance a person needs, that is term insurance. Next. Okay. Now, life insurance, just a brief on it. It is a risk management tool. The best type of life insurance is a term insurance. Now, we go on to health and critical illness. These are very complicated insurance in the sense that this will vary from person to person, and we look at it in much more detail. Next. Okay. Now, we don't recommend any type of health insurance policies. We have a separate health insurance team where if you do require a health insurance policy, they'll be happy to help you with it. But primarily, these are the three things that one should look at before you buy a health insurance policy. If you have these three things in check, you're pretty good when you take a health insurance policy. The first thing is copay. So what is copay? Let's say you get admitted to an hospital and the health insurance bill turns out to 1 lakh. Let's say you also have a health insurance policy and it has a 20% copay subclause, meaning you'll have to pay the first 20%. After the 1 lakh medical bill, 20,000 will have to be paid by you, and the rest 80,000 will be paid by the insurance company. Now, coming on to the second thing, which is room rent limitations, this is very, very important, because let's say you go to a hospital like an Apollo. You go there and they say that the only kind of room that is available here are suite rooms. There are no single private rooms. There are no deluxe rooms. There are no different types of rooms available. But after getting admitted, you notice that, okay, my health insurance policy will only cover a single private room. A suite room is not covered. But in the case of an emergency, you won't obviously think that, because the importance of life comes first. So always take a policy where there are no subdivisions, there are no limits on any type of rooms that are covered. Each and every type of room should be covered, and there shouldn't be any limits as well. Because let's say your policy only covers till a private room and you get admitted into a suite room, whatever procedure that happens in the private room will not be covered under insurance. Now, the third is disease-wise supplements. Now, I'll take a small example to illustrate this. There is a disease called hernia that a lot of you might know about. There are two types of ways to cure hernia. One is through surgical intervention. The second is through use of laser treatments. Now, obviously, people would want to go for laser treatments because these are advanced methods. They leave a very fraction of a scar that a surgical treatment might leave. Now, but your policy might say that we'll only cover surgical treatments, and even in a surgical treatment, we'll only cover it up to the extent of 50,000 or 60,000. Now, Apollo might charge you 1 lakh, or another hospital might charge you 1.5 lakh or more. Now, this is where having no disease-wise sublimits comes in use. So, if you can find a policy without these three things, you should be pretty good for most things. The fourth thing that I would add is existing waiting periods. Now, for most policies do have waiting periods, and there's nothing much you can do about it. My advice would be to go for policies with as low as a waiting period as possible. Next. Now, a short walkthrough on the type of life insurance products that are available in the market. Now, just to begin with, the last one or the fourth one, the term insurance that you see, that is the only product that you'll ever need in terms of life insurance. First one is whole life. What is whole life? Pretty much you're covered till the age of 99. But since that, there is a higher probability of death before 99, there will be some sort of payment that is made by the life insurance company. But because there is some sort of payment that is made by the life insurance company, the premium that is kind of paid is much higher in a whole life policy. These provide fraction of a cover that a term insurance policy provides. For example, a whole life policy might offer you a 10 lakh premium for a 10 lakh cover for a 20,000 rupees premium, but a term insurance might offer you a 1.5 crore or 1.7 crore cover for the same amount of premium. Now, second is endowment. These are pretty much your money back policies. You want to stay as far away from them as possible. Why? I'll show you this with an example where this is much clearly illustrated. And last is ULIP. ULIPs are kind of the worst in the bunch because they'll combine investments and insurance, where the insurance is not sufficient, the investment is also not sufficient, and these are usually have a lot of charges also involved in them. Next. Next. Okay. Now, why shouldn't you go for a money back policy or a endowment policy? See, just a small example. We'll take a policy. The policy says you pay 22,000 for the next 12 years, and you get 3.5 lakhs maturity on the 13th year or at the end of the 12th year. How the policy is usually marketed is that such that you get 12 times return, your 15 times return is what they say. Now, you also get a life benefit of 3 lakhs in the case of your death. Now, when we go towards the back of the policy and we do the working, let's see how this policy turns out. Next. Okay. Now, let's say someone at the age of 33 takes this policy and he continues to pay the premium for the next 12 years, and he also gets the benefit. Now, if you look at it, he has paid 22,786 premium for the next 12 years. And on the 13th year, he gets a 3.47 lakhs as a maturity amount. This is also includes the bonus that the policy accumulates each year. Different policies have different kinds of bonus. But what you can see, what number is really important is that the XIRR return at the bottom of the policy. Now, if you guys look at it, this is the most important part of the policy. The policy, however much you'll pay, will only give you a 4% return. Now, this is where money back policies or endowment policies don't even beat your inflation. See, what kind of cover does it provide? It provides a very, very low cover. 3.5 lakhs cover or a 4 lakh life cover is nothing. After paying premiums for 12 or 13 years, getting a 4% or 5% return, your average FD will provide you better returns than this policy. So this is where you kind of stay away from these money back policies. Now you might ask, okay, I have started this policy. What can I do? There are two things that you can do. One, if you're very near to the end of the policy, let's say you're 3 years out, 4 years out, I've paid premiums for this long, then my suggestion would be stay course, complete the policy, get whatever benefit they give you, stay away from these policies in the future. Now, in the second case, what happens if I've just started the policy, or if I've started the policy and I've completed 2 or 3 years? Now, my suggestion in that case would be two things. Either you surrender the policy and you come out, yes, there will be a loss, but this loss is much better than continuing with the policy for the next 13, 14 years. Or the second thing would be to make your policy paid up. So what is paid up? Let's take an example. You start an insurance policy, and on the 3rd year, you notice that, okay, this insurance policy is not going to work out for me. I'm going to not continue paying it. Now, if you surrender it, you will only get 30% or 40% of the premiums back. It will be at loss. Now, if you make it paid up, whatever the amount of premium you paid till that date, you don't have to pay anything after that. You can stop paying premiums. But for the premiums that you paid, you have accrued some kind of value, right? That value would be paid at the end of the policy. For example, in this policy, it would be at the end of the 12th year or at the start of the 13th year. So both of these options are good. My recommendation would be, work out this policy, contact your financial advisor. We'll be happy to help you in reviewing your insurance policy and happy to help you take a decision on this as well. Next. Okay, now I'll just give you a very good example to illustrate what kind of policies these are. You guys all know Abhimanyu from the Mahabharata, right? He's the son of Arjuna and he's closely associated with the defense formation Chakravyuha. Now, LIC policies are kind of like these kind of policies where you get into these money back or endowment policies. When you get in, you kind of don't read the terms. You kind of get in because someone, your relative or your close friend sold it to you. Now, once you get in, like it happened in Mahabharata, Abhimanyu succumbs in the Chakravyuha. So this is how these policies work, where you get in, you can't get out, and even if you stay the course of the policy, you get a 5% return, which doesn't even beat inflation. So our advice: avoid these policies. There are only two types of insurance that a person needs: a good health policy, a good term policy, and that's about it. And of course, there are motor insurance, there are property and casualty insurance. Of course, all of these are there, and all of these are kind of mandatory in this such. But for a personal need, a health and a term is all you ever need. Next. Okay. Now, checklist to see if an insurance provider is good. Now, let's take, there are a lot of insurance companies that are available in the market, right? How do you know if an insurer is good? First thing is credibility. If they are a very big company, if they have a very big parent backing them, most insurance companies should be good in this sense. Second is claim settlement ratio. This is very, very important. An insurer with a high claim settlement ratio is better than an insurer with a low claim settlement ratio. That is the point of it. Always go for someone with a high claim settlement ratio. Persistency ratio. Now, this is kind of a financial metric, but I'll explain it anyway. This means that the ratio of policyholders that have renewed their policies with the same insurer. So, for example, I'll take a policy with the X insurer and I keep renewing it year on year because the policy is good. If people keep renewing the policy year on year, that means that the policy is obviously good. Maybe the claims have been paid out. So having a high persistency ratio is pretty good. Solvency ratio, this is to note the the health of the insurance company. Most health insurance companies do have a good solvency ratio. Next. Okay. First thing is, how much insurance do you need? This is a very, very touchy topic, but I'll give you a kind of a thumb rule. Let's say you have a home loan. Let's say you have a car loan. Let's say you have a personal loan. Let's say you have a gold loan. Add all of these loans into how much insurance that you will be needing. Then you come to what kind of monthly expenses that you have and multiply it by 15 or 20. Okay. Take your yearly expenses, multiply it by 10 or 12. You'll get your 12 years kind of expenses that you'll need to provide for your family. Add that back to the amount of loan that you've taken. And you add a kind of a 10-15% buffer as well. Let's say you add all this and you subtract some of your assets and you kind of get around a 1.5 crore or 2 crore health life insurance policy. That is the kind of life insurance that you need to take. And for health insurance, we say usually have like at least 4 lakh or 5 lakh per person. Let's say you're taking it for a family of 3. That means take a sum assured of at least 15 lakh. Usually we say don't take your bonuses into account because the no claim bonus does add up, but it will kind of come down when you claim it. So it's kind of risky. Always take it for a higher sum assured. Is your policy cost effective? This is very, very important because some policies, while having all the kind of clauses, they might be really, really expensive as well. Some senior citizen policies, while they don't cover a lot of things, they are very expensive. So, contact us. We have a very good insurance team in-house who will be happy to review your insurance policies as well as provide you recommendations as well. What does your policy not cover? This is the most important part of it because you can pay a higher premium. You can have a lower coverage as well. But what happens if your insurance policy straight up doesn't cover it? This is something that will change from policy to policy and from person to person, because a person might have diabetes as a pre-existing condition. I might have an heart condition as a pre-existing condition. So this is where it's a kind of a personal touch is required. And always consult your insurance advisor before you take any of these policies. Next. Okay. The next part of this presentation is on tax. As we all know, tax gets deducted directly out of a salary. But is there a way where I can pay reduced tax? And we'll also bring more kind of clarity on the old versus the new tax regime, and which you should go for and which will result in a lower tax for you. I'll pass it on to my colleague Vinayak, who will take this forward.
Yeah, thank you, Nakul. So tax planning would be one standard and legal way to reducing your tax liability. So actually effective tax planning will help you save a lot of money and park it and redirect it towards your financial goals and financial objectives. So let's find more about tax planning. So there are a lot of questions. How to minimize the tax liability? What are the optimum utilization of the income tax acts and the tax reductions that are already available? How to avoid and why to avoid future penalties? Why to increase the savings and what is a disciplined way of investing? So there are actually two forms of taxes that we pay towards government. That one would be direct tax and one would be indirect tax. Indirect tax, we pay it via income tax, a capital gain taxation on equity, mutual fund, everything. And indirect tax would be something like a GST that we usually unknowingly pay towards the government. So there are two major direct taxes component that we usually need to be aware of, that is income tax and capital gain tax. In income tax, there are two regimes to choose. So every year, a salaried professional can choose from this old tax regime and new tax regime. So I'll give you a brief about both. So in old tax regime would be suitable for someone, those who have a lot of deductions. So one thing is in old tax regime, as you see, whatever tax deductions that you have under section 80C, 80CCD, etc. can be claimed as a deduction. And in this, your taxable income, you can reduce it and lower down your tax liability. New tax regime is very simple. It was recently introduced by Nirmala Sitharaman in the new budget. So in new tax regime, what happens is you can't claim any tax reduction, maybe provident fund, investment, NPS, anything. But in new tax regime, what is the benefit is the tax rates are comparatively low. So as you can see on the screen, based on the income slabs itself, the tax rates are comparatively very low in the new regime. So how to choose the tax regime that is very suitable for you? So you can reach out to us. We'll be helping you out in choosing the right tax regime. And in that case, we'll be helping you out in reducing your tax liability. One more thing to be noted is, under new tax regime, if your salary is below 7 lakhs, you don't have to pay any taxes. So this was introduced in the new budget. And yeah, this is one thing you have to be aware of. So apart from this, it's like we'll focus more about the tax reductions that are already available in the market. So under section 80C, specified investments like a PPF, life insurance, and even children's tuition fees can be covered as a tax reduction. So what you may ask is like entire children's tuition fee is not covered. It's like when you pay the fees, once you get the receipt, there would be a minor table called as children's tuition fees. Apart from your library and your bus transport expenses, there whatever children tuition fee is there, that you can claim up to 1.5 lakhs under section 80C. Apart from that, any investments in NPS above 80C investments that we have up to 50,000 can be claimed as deduction under NPS. It is only for NPS tier 1 accounts. So apart from that, section 80D, medical insurance. So if you're paying medical insurances such as health insurance premium, etc., up to 25,000 you can claim in this tax deductions. Apart from that, there's something called as, so if you're paying for any medical premiums for your parents, for your senior citizens, up to 50,000 you can claim towards their medical insurance premium paid. So combined for a family, you can claim up to 75,000 under this section 80D itself. So also, if any one of you is having an education loan, interest paid on that education loan, there's no maximum limit. So whatever interest you're paying towards your education loan, you can claim it under section 80E. Apart from that, a lot of home buyers, whatever principal amount is there up to 1.5 lakh limit can be claimed under section 80C, and whatever interest component is there of your home loan EMI up to 2 lakhs per financial year can be claimed under section 24. So these all deductions are important to be known if you're going for an old tax regime. So yeah, so these are the few of the tax reductions that we are generally not aware of, and the rest were usually in the limelight. So under section 80G, donation to notified charitable trust and NGOs can be claimed up to certain percentages. And apart from that, your interest on a savings account under section 80TA up to 10,000 can be claimed as a deductions. So as you saw, it's like there are two regimes, that is old tax regime and new tax regime. So we have a case study. So in this, we'll try to figure out what regime would be suitable for this person. So meet Ram, his CTC is around 12 lakhs per annum. Which tax regime should he choose? So let's see. So under old tax regime, Ram is making a deduction of 1.5 lakhs and maybe investing by life insurance or under PPF or EPF. Under home rent allowance, he is claiming a deduction of about 1.2 lakhs. So his net taxable income from 12 lakhs is about 8.8 lakhs. So the total tax liability under old tax regime would be 92,000. Under new tax regime, without any deductions, with lower tax rates, let's find out what would be the total tax liability. So without any deductions, just by lower tax rate, the Ram's new tax regime, the total tax liability would be somewhere around 85,800. So there's a difference of 6,200, right? So yeah, so proper tax planning and proper choosing the regime from old tax regime or new tax regime can help you save in tax liability. There's one more case study. So let's figure out. Meet Alia. She has a CTC around 25 lakhs per annum. So what tax regime should be chosen by her? So actually going for old tax regime and new tax regime depends about a lot of deductions. So if you have a home loan, education loan, if you're claiming HRA, so obviously old tax regime would be in your favor. So let's find out what is in favor for Alia. So right now the CTC annual gross income would be 25 lakhs. And she's claiming 1.5 lakh under section 80C, 80CCD investments in NPS of up to 50,000, medical insurance premium up to 25,000. And also she has a home loan of which interest amount she's claiming about 2 lakh rupees per annum. So with all this, the total net taxable income of Alia would be somewhere around 20 lakh 25,000. So the total tax liability would be somewhere around 4 lakh 36,000 per financial year. But in new tax regime, the total taxable income being 24 lakh 50,000 after the standard deduction of 50K, the total tax liability would be somewhere around 4.5 lakhs. So that would be a difference of 15,600. It's not always the same case. What if it's like new tax regime would be favor for the client? Maybe if you have a lot of deductions, old tax regime would be in favor for you. So in that case, if you want to figure out what tax regime to choose, you can reach out to us when we'll be helping you out in figuring out the same. So next, we'll be talking more about investment avenues that is available in the market. So Nakul will be continuing the same.
Thank you, Vinay. It's a nice peppy session on tax. Now we look at, like I said, insurance is meant for protection, and there are different investment options that are available. Now we look at what are the investment options that are available from the side of the government. Then we'll also look a little bit more on mutual funds as well. Next. Okay. The first thing that's very important that often gets deducted from all of our salaries is EPF. EPF is something, don't touch it, just let it accumulate. This is for your retirement. EPF and gratuity is meant for your retirement. Leave it as such. This is something that a lot of people know about. Now, what a lot of people don't know about is VPF or voluntary provident fund. Let's say your company only deducts the minimum amount for EPF, or you want to contribute more towards PF. How do you do it? You do it through VPF or voluntary provident fund. I'm sure you all have your UAN numbers. Go to your EPFO portal, and that when you kind of enter your UAN number, you'll be redirected into the site. You can kind of choose VPF as an option. You can contact your HR for choosing VPF as well. VPF is a really, really good investment. And if you hold your VPF for 5 years, you don't have to pay any tax on it as well. If you withdraw it before 5 years, it will be taxed. And another very important instrument that a lot of people should know about is PPF or Public Provident Fund. Now, what is this? We'll talk a lot more about something called Suganya Samriddhi later on. But one thing about Suganya Samriddhi is it's meant only for daughters. Now, what do you have for a male child? You have something called a PPF. PPF is a 15-year instrument. What money you contribute what interest returns, and the final amount of money that you get on maturity, all three are exempt. It falls under the exempt category of taxation, basically meaning there's no tax on it. It is a 15-year instrument. You can contribute monthly, you can contribute yearly. It has a maximum contribution limit of 1.5 lakhs. It's a very good instrument if you plan to, kind of invest for your child's education or wedding or things like that. Next. National Pension Scheme, one of the most important schemes for someone's retirement. This is often overlooked in India. It's a very underrated scheme. So what is National Pension Scheme? National Pension Scheme is a pure retirement product, meaning you can withdraw it in most cases only after 60. It's given pretty stellar returns, usually ranging from 9 to 11%. It has a kind of a very good asset allocation as well, meaning you can choose equity, you can choose your bond allocation, you can choose your corporate bond allocation, your government bond allocation. So it's a very versatile investment. You get a 50,000 rupees tax deduction under NPS as well under the old tax regime. And what happens on maturity? Let's say on maturity, you have accumulated around 10 lakhs in NPS. 60% of it, that is 6 lakhs, you can withdraw it tax-free on that day. Now, what happens to the rest 40%? This rest 40% will be paid out as something like an annuity every month on month. And after your nominee will get the rest 4 lakhs as well. There is an option for premature exit, but we don't recommend it. We don't advise it. This is a retirement product. Is similar to something like a 401k scheme in the US. Keep it purely for your retirement. If you do want to take a premature exit, that is something not recommended. Yeah, there are tier 1 and tier 2 schemes as well. You can kind of contribute to tier 1 only has the tax deduction. Tier 2 is something just like a mutual fund where you can contribute, you can take it out. You can kind of, it's just like a mutual fund. We recommend tier 1 because that does come with the tax deduction and the lock-in. Tier 2 doesn't have these things in place. You can kind of park your money in and take it out whenever you want. Next. Yeah. Okay. Post office monthly income schemes. What is this? Now, this is a very good alternative to a fixed deposit. It's currently offering you 7.4% interest. The maximum a person can contribute is 9 lakhs, and as a joint holder, you can contribute 15 lakhs. Your capital is completely protected because it's backed by the government. And as the name suggests, this is a monthly income scheme, meaning you'll receive a monthly interest income for a period of 5 years. And after 5 years, you'll get your invested capital back. Now let's look at an example to illustrate this better. Okay. Let's say you invest the maximum amount, 9 lakhs in this scheme. For the next 5 years, at the rate of 7.4%, you'll get around 5,550 to 6,000 rupees month on month. And after 5 years, you'll get the 9 lakh amount to your bank account as well. This is a very good scheme. If let's say you have aged parents who you want to park some money in their name, or you want to park some money in your name where you think, okay, I do have sufficient corpus in equity, I want to generate a monthly income. Post office monthly income scheme is a very effective scheme at that. Now, next scheme we'll be looking at is something that's slightly better than the post office monthly income scheme, meaning senior citizen scheme offers you a good interest that is at 8.2%. But one thing to keep in mind about this scheme is that it's only for people over the age of 60. So if your parents over the age of 60 or grandparents, you can park money in their name. This is backed by the government. And recently they have enhanced the deposit limit to 30 lakhs per person. So a very good scheme to invest in the name of your parents. The interest is also very high, but unlike the monthly income scheme, you don't get the monthly interest, you get a quarterly interest in place. Next. Okay, now coming to equity linked savings schemes or ELSS. This is often people's first foray into mutual funds. Now we look a lot more on mutual funds because we think that is very important. Now, what is the equity linked savings scheme? It's basically a mutual fund. It can be a tax saver fund is what is often called. It has a lock-in period of 3 years, meaning 3 years you can't take your money out. In the past, what we've seen is that people who invested in ELSS often reap the benefits of equity because equity over a span of 3 years usually ends up performing at least somewhat, and people are content with that, and they kind of extend the scheme. And then when they extend it, let's say for 5 or 6 years, equity, there's a higher probability that equity ends up doing well, and they kind of, apart from the tax benefits, they also end up growing along with their mutual funds as well. So it's a very, very good investment. It's most people's first foray into ELSs. But one thing to note is that with the rise of the new regime, ELSS kind of loses its value, because let's say you choose the new regime, there's no incentive for you to go for the ELSS, because you kind of can't claim the tax deduction under the new tax regime. Next. Okay, Mahila Saman Savings Certificate, another very interesting scheme that was introduced by our Finance Minister Nirmala Sitharaman in this budget. So what is this? This is only for women, Mahila, as it suggests. It's for a period of 2 years. So let's say you invest now, 2025 September or October month, you will get the amount. It's currently 7.5% compounded annually. It's very low risk or no risk since it's backed by the government. The maximum amount of money that you can invest in the name of one female person is 2 lakhs. So we look at an example of this as well. So let's say I have 2 lakhs today, or let's say you have 2 lakhs today, and you want to invest in either your name if you're a female, or you want to invest it in your mother's name, or your daughter's name, or your children's name, or your wife's name, whatever it might be. Let's say you invest 2 lakh now, and at the end of 2 years, you'll kind of get 2,32,000, 2,33,000. So it's a very, very good scheme, because unlike the other schemes that we talked about, this is a scheme with a very short maturity period. 2 years is pretty short, and 7.5%, 8% interest for this period is pretty good as well. Okay, National Savings Certificate, again, a very good instrument to save kind of money. If you do have a lump sum amount, instead of parking it in an FD where you'll be charged TDS every year, you can park it in a National Savings Certificate, because in a National Savings Certificate, only the 5th year, the maturity amount will have its interest taxed. Every year interest is not taxed. So your amount kind of grows at a higher pace, because higher amount gets compounded year on year. It's a 5-year instrument. It currently has 7.7% interest. It has tax benefits under Section 80C as well. We look at a quick example to see how this works. So for example, let's say I have 10 lakhs today and I park it in a National Savings Certificate. For the next 5 years, I'll continue to earn compound interest. And on the 5th year, I'll kind of get 4.5 lakhs as interest. So almost my capital, half of my capital is earned as interest as well. So the maturity amount would be around 14.5 lakhs, 14.49 lakhs is expected as well. So National Savings Certificate is a pretty good instrument if you want to grow on par with inflation, or maybe slightly lower than inflation. Okay. One of the most interesting schemes is if you go to a store, if you want to buy gold for your spouse or for yourself, you often can't buy it without these things. GST is something that you can't even imagine buying gold without. Making charges, wastages, the concerns surrounding purity, and all of these things are there. So to combat all of this, RBI kind of introduced sovereign gold bonds. So what is SGBs, or sovereign gold bonds? These are instruments where next slide. Okay, sovereign gold bonds. So one bond equal to 1 gram of 24 karat gold at 99% purity. I think currently this is at 5,800, 5,900. Let's say you buy 5 bonds, which is equal to buying 5 grams of 24 karat gold. You'll have to hold it for the next 8 years. Of course, there is an exit option available at the end of the 5th year as well. But if you hold it for 8 years, you get the value of gold on the 8th year. So let's say after 8 years in 2031, the value of gold, for example, is let's say 10,000 per gram or 11,000 per gram. Let's say you bought 5 bonds, which is equal to 5 grams. You'll get around 55,000, 60,000 in your bank account. There's no GST on it. There's no making charge. There's no wastage. Since this is just paper gold, you don't have to pay anything about it, and you don't have to worry about it as well. Sovereign gold bond is probably the best way to invest in gold. You kind of avoid the tax, you kind of avoid the making charges, wastage, and on top of all this, the government gives you a 2.5% on the purchase price of your gold for the 8 years. So over 8 years, this continues to compound as well. Now you tell me, if you buy a gold in a shop, do you get interest on it? No, right? So that is why sovereign gold bonds is probably the best way to invest in gold. If you have a 8-year tenure or a 10-year tenure and you want to buy gold, sovereign gold bond is the best place to go for. Next. Okay. Again, a very, very important scheme in the Indian context, a Suganya Samriddhi. So what is Suganya Samriddhi Yojana? This is meant for your girl children or for your daughters. And one very important thing to note about is that you can only enroll your daughters if they are under the age of 10. If they cross that limit, this scheme will close. Then you might ask, what can I do about it? Then you'll have to go for something called a public provident fund. How does this scheme work? The number 21 is of utmost importance in this scheme. So you'll contribute, you'll invest for the first 15 years, and for the next 6 years, this amount will continue to grow. So for example, it's currently giving you 8% interest, and the minimum investment is 250 and the maximum is 1.5 lakh. So on the next slide, we look at a case explaining this. Okay, let's say you invest 3,000 a month when your girl is 5 years old. So you invest for the next 15 years. And after 15 years, you give your money 6 years to compound. That is total tenure of 21 years. So let's say you start investing at 5 when your daughter is 5. So 21 plus 5, which is 26. She'll get a maturity amount of 6.16 lakhs. That is completely tax free. Now, this is a very, very good scheme to invest in. And now, in the next slide, you'll see that if I double my monthly contribution from 3,000 per month to 6,000 per month, the corpus that I generate will also get doubled. Now, the government also gives you an option of early withdrawal when your daughter is 18. That is, when your daughter is 18, you can withdraw 50% of the accumulated corpus for two purposes. One is education, the other one is wedding. So this is something to consider as well. But in most cases, Suganya Samriddhi is a very, very good scheme. If you keep contributing for the next 15 years, and when your daughter turns 21 or 22, depending on the age that you invest in, you kind of have a sizable corpus in their name. Next. Okay, now we come to a very, very important aspect about it, that is mutual funds. Now, just a primer on it before we go ahead. Traditionally, India has been investing in assets such as gold, FDs, RDs. These are all traditional investments, meaning, they'll give you returns on par with inflation or slightly lesser than inflation. Now, what the inflation numbers that the government gives you is around 6 to 7%. But what we usually like to think is that, okay, this is, maybe take a percentage or two, added more, if you're able to get 7 to 8% or 9 to 10% consistently, you're kind of beating inflation, you're kind of growing your wealth. If you're not doing that, inflation is kind of eating up into your wealth as well. So this is where mutual funds are very, very important. They are, they can be a great tool to create wealth over a very long period of time. So, keep your horizon at least as 5 to 7 years. 4 to 7 years is also a good horizon. If you have it more than 10 years, that's well and good. Now, on the next slides, we'll illustrate, how mutual funds create wealth. Okay, a very good example. Let's say Sonu and Moon, both of them start off investing. Both are planning to retire by the age of 60. Both of them start with a monthly SIP of 20,000 per month. So what is an SIP? An SIP is a systematic investment plan. What is a systematic investment plan? Very simple. Let's say you want to invest in a mutual fund and you want to invest every month. When you want to invest every month, that is called a systematic investment plan. That's about it. Let's say you buy a new phone in Amazon over EMI. You kind of pay EMI every month, right? Think of an SIP as a good EMI. That's about it. Okay. Now, their portfolios grow. Let's say they keep on growing their portfolios. Next. Yeah. Okay. Now, let's say over a 10, let's say Mono starts investing at 30 years. Now she kind of stops investing at the age of 50. She invests for 20 years and she stops her SIP. But she doesn't pull out her money. She lets it compound. Excuse me. So over the next 10 years, this 1.4 crore corpus compounds to 3.3 crores. Now we look at Sonu at the bottom where, she kind of postpones it and she kind of starts investing only at 40. Now, even though she invests for the next 20 years, she's only been able to accumulate kind of 94 lakhs to 1 crore. This is where the amount of time comes in, because even if you start with a smaller amount of money, it doesn't have to be a 20,000 rupees SIP, can be a 2,000 rupees SIP. The amount of time that you contribute plays a very, very big role. Because this is where compounding comes into effect. If you're someone who can contribute, you have 10 years, 12 years to contribute, and you kind of start now, you kind of can create a very, very big corpus through mutual funds. Next. Okay. This is the formula that we use to kind of arrive at that number that you saw on the previous screen. So the amount is what we focus on. This is what, we want more money. We want to, generate bigger capital. The amount is what we all focus on. But what should we all be keep focusing on is the small t at the top of the formula, which is the time. Next. Yeah, this t is what really makes the difference. If you can have kind of a more time on your side, that is when, mutual funds kind of will give you better returns. Mutual funds are tied to the growth of the economy. So as India does well over a long period of time, mutual funds also end up doing well. So what makes an even bigger difference is what we've seen even with our own clients is that people who've been investing for 5 years, 6 years, 7 years, they kind of reap the benefits of it. Because I'll be very honest, over the short term, mutual funds are kind of, they are kind of volatile in nature. You can't predict where, the next 1 year or 2 years, how the companies are going to perform. But over the next 10 years, you kind of take a growth prospect on India, and you kind of can be confident that India will and can do as well. Now, why should someone go for mutual funds? See, very simple. The first thing that mutual funds should kind of come to your mind is suitability. Now, if you look at the government schemes or an FD or an RD, the amount of money that you kind of need to put in is kind of huge because you need a kind of a higher lump sum to put in. But in mutual funds, this is not the case. It's very suitable for every type of investor. I can start with 1,000. You can start with 500. Someone can start with 1,00,000, or someone can start with even 1,000 rupees per month. This is where mutual funds are kind of suitable to everyone. Diversity. See, you pick an FD, I pick an FD. The interest rate might vary, but the product is going to be similar overall. But mutual funds can be tied to your goals. I can pick a very, very risky mutual fund. Let's say if I'm someone who can take risk and can invest till retirement. Now you might be someone who wants to take moderate risk and wants to invest only for the next 5 years. That means you kind of can go for a moderate kind of risk mutual fund. So the different kind of mutual funds that cater to different types of investors as well. Liquidity. Now, if you sell a mutual fund, you kind of get your money back in the next 3 days or 4 days. This is where mutual funds are very, very good. Whereas in the case of real estate, we've seen that selling it takes a lot of time, and realizing that many takes even longer. Mutual fund is regulated very well by SEBI. There's a lot of variety. You can kind of have mutual funds that cater to gold, small cap mutual funds, large cap mutual funds. You kind of have international mutual funds. There are a lot of mutual funds that are available in the market. Now, what do we need from an investor? Discipline through an SIP. You invest month on month through good mutual funds. You can kind of create good wealth. Flexibility. You can kind of invest 1,000 this month, maybe 2,000 next month, maybe nothing next month, maybe double the amount the 4th month. It kind of gives you flexibility as well. So now, what is very important is that there are 3,000 to 5,000 mutual funds in the market. Not all of these are equal. In fact, all of these are very different in nature. And that is why you need a financial advisor to help you kind of process through these mutual funds. Pick the right one out. That is where a financial advisor comes in. Next. Okay. Now, we want to illustrate the concept of the SIP. See, an SIP is simple. Let's say you kind of start off buying at 29.04 and you kind of buy it at every single dip. This is where an SIP will help you average out that cost. See, we've been in the market for a very long time, but even we're not able to tell you, when the market is going to shoot up, when the market is going to go down, because this is primarily out of our concern, out of our control. But what is something that we can control? What is something that we can control is our own behavior of investing monthly, investing in a disciplined way, investing in a systematic way. That is where the SIP power comes in. Next. Okay, now. All of us want to be crorepati's, right? How do we do this? A very small illustration. Let's say you do a monthly SIP of 20,000. Now, what I would say is that 20,000 might be a bigger amount for most of us to start with. You start with 1,000 or 2,000 or 3,000 and you kind of step it up year on year. That works as well. For this illustration, we've taken 20,000, taken an average return of 12%. And if you do it for the next 15 years, you create 1 crore. Next. Okay, now I want to take you guys through this graph. It's a very, very important graph because what you can see is that different asset classes over a period of time. Now, just as an example, in 2022, if you look at the last column, gold has done very well. Gold is given you around 11.3%. But if you look at 2021, gold has been the worst performer. Now, what do I want to illustrate this image with? Asset allocation is what I want to illustrate this image with. Asset allocation is very, very crucial. How much of your assets is in debt? How much of your assets in equity? Even within equity, how much of it is in large cap or mid cap or small cap? How much of bonds that you have in your portfolio? All of this is very important because even in a year when equity doesn't perform, if you have gold in your portfolio, that can act as a very good hedge against the uncertainty. So this is where asset allocation finds a primary role, and asset allocation should be tied towards your goal. For example, let's say you want to buy a car in the next year. It doesn't make sense for you to invest in equity instrument. But let's say you have your retirement is 10 years away. Then equity is a good place for you to invest in. For short term, we usually say, park it in FD, park it in RD for a 1 or 2 year goal. If your goal is more than 3 years, then come towards equity, then participate towards equity. So all of us have different goals. So equity can play a role in any one of these goals. Next. Okay, now, mutual funds are something all of us need to do. What should you not do? Very simple. Don't go for money back policies. Don't go for endowment policies. And most importantly, don't go for any policies that your bank sells to you. These are usually very fees and incentivized product where, the person who's selling it to you often gets a huge chunk of commission. They have a very good incentive to kind of push it towards you guys. These are products where, primarily just stay out of it. If you stay out of it, that is even enough for you to kind of create wealth. Next. Okay, now I want to give you a brief example on how 2023 is going to be. 2023, what we've seen till date is it was a volatile market. Nifty is currently at around 19,000, 20,000. It's kind of at his lifetime high. But what we've seen is that only certain sectors of the economy have gone up. Small caps have done well. There has been a frenzy in these kind of instruments where we see a lot of investors, flocking through towards these kind of products. But that is not how it usually works. If there is a frenzy, a lot of people are going towards it. That is something of an area, we kind of want to avoid, we kind of want to stay away from. SIP is still the best way to go towards, accumulating in 2023 and after 2023 as well, because it kind of lets you average your cost. Lump sums are kind of, if there is a market dip and if there is a good opportunity, you can kind of, a lump sum can be a good option as well. But even with the lump sum, deploying it through systematic transfer plans or STPs are a good example. Next. Okay, we've come to the flag end of the slide. So what should you be doing? So what we recommend you do is that people should start off with an SIP. An SIP is probably the best way to kind of say, next slide. Okay. An SIP is probably the best way to save. Let's say you start off an SIP of 10,000 and we assume a return of 12%. And let's say you give it 15 years. You would have invested 18 lakhs and you would be, half a crore. Your total value would be 50 lakhs. This is just an illustration. Now, what is something that can be done better in this arena? Next. Okay, what is this step up? Step up is simple. You start off with 10,000. Next year, you make it, 10% more. You make it 11,000. As and when you get hikes, as and when you get bonuses, your SIP doesn't stay constant. It shouldn't stay constant. I earn more. Let's say I aspire to buy a better car. I aspire to buy a better phone. Correct. So I should aspire to, invest more as well. That is where, let's say you kind of step up your SIP by 25%. Your total value of our investments also goes up multifold. Okay. Now, what happens, if you have a one-time lump sum investment to invest, let's say you invest it over the next 15 years, it kind of gives you 55 lakhs. Now, even for lump sum, what a better option would be, especially in this market scenario, is, parking this lump sum in a safer instrument, such as a debt fund, and then initiating something like a systematic transfer plan, where over a period of 25 or 30 weeks, this goes towards equity. Next. Okay, now what is a good combination is that, let's say you have a lump sum, let's say you're doing an SIP, you combine these two things together and you have a winning combination, because your lump sum is kind of investing, and because the market timing is kind of a little bit more important with the lump sum, correct? Because that is doing well and your SIP is kind of averaging it out as well. And you kind of add an ST and step up to this, you kind of get the best of all three worlds. Okay. A very important concept is that wealth creation is a marathon. Wealth isn't created over a 2-year or a 3-year period. Wealth usually takes substantial amount of time to create, but over a period of 7-10 years, what we've seen is that the amount of compounding that works on your wealth is far higher, and you kind of do much better over the long term. Next. Awesome. We've come to the flag end of the presentation. Please post your questions in the chat. We'll be answering your previous questions as well. Whatever the question may be, me and my colleague will be happy to answer. Okay. We'll start off with the Q&A as well. I'll come to the first question. This is from Ravi. For emergency fund, can we invest in short-term fund? Please advise. Yes, sir. Emergency fund are usually to be kept in liquid instruments or kind of FDs or kind of safer kind of investment. These are kind of the options to go for. Even within liquid funds, there are different types of funds to invest in, even within debt funds. So please do contact us. We'll be happy to help you out in this regard. Okay, next question.
So Ravi sir had replied, I am 51 years age. As of now, there is no insurance taken. Please advise which type of insurance is suitable for me. So in that case, it's like we'll need a lot of scenarios where what would be your retirement goal and what would be the basic plan. So in that case, you can reach out to us. Our insurance team would be at a better position to help you out and whatever insurance is needed.
Yeah. Okay, but off later until this March, this is from Madhusudan sir. But off later this March, there were guarantee payout policies that were more beneficial, giving higher yield, close to 6.5%, fully tax free. What about those policy? So simple, sir. Getting even a 6.5% yield after tax free, this isn't getting even close to inflation. Whereas equities are tax advantaged as well, meaning you pay a flat 10% tax on long term, and let's say your mutual fund does not even 12%, let's say your mutual fund does 11%, maybe 10%, you're still better off than these policies. And one thing to note about these policies is that the life cover that they give you isn't good, sir. It's not enough. We recommend at least a 1 to 1.5 crore life cover even at the start. So, that is something to take into account. And lifelong tax-free provision by locking at higher rate for longer term when FD may not offer such, considering lower. Also, FD is fully taxable, so net post-taxable. So 6 to 6.5% secured for long term. Your inflation will kind of eat up that return, sir. Over the long term, let's say you end up making 10 to 12%, anywhere in that range, you kind of can double your capital more faster. But if you do get a 6.5 return, while that might be guaranteed, it will kind of put a cap on how much you can earn. So why put a cap on how much you can earn, sir? Especially over the long term.
So can we take the corporate health insurance and convert into personal after corporate life is over? No, sir. Actually, you'll need an individual health insurance cover. So once your employment term is over, the policy with the corporate will be lapsed. So it's obviously very important to take an individual health insurance cover rather than your corporate health insurance cover too.
Yeah. You want to take the next one, Vinay?
So my wife is a housewife, but based on my income, she's operating Demat account. For her investment, LTCG, she need to pay tax or no? Please advise. So first year, what would be the work is If it is from her savings, obviously wife would be the taxpayer. And if it is below the slab rate, she doesn't have to pay any tax. But if it is suppose from the income that you have earned and you have given to your wife, so it can be claimed back as a gift to your wife. But other than that, if it's from her savings and if it's below the nominal slab rate, we don't have to pay any tax.
No. Vasanta Kumar says a tier 1 also no limit. I think this is based on NPS. Yes, sir. Tier 1 also doesn't have a limit. The limit, as we say, is on the tax thing. So the maximum limit that they'll give you is 50,000 for the tax thing. So that is the limit that we were referring to. Okay, another question from Madhusudan as well. But sequence of MF returns are not consistent or guaranteed, right? A few years it will be great, but many years we see drag or low only as most returns are from a few years old. Correct, sir. So the sequence of MF returns are not consistent, they are not guaranteed. So that is why there is no cap on it, because how much ever you contribute, an FD is going to give you 7.5%, and that's about it. But an MF has the option of giving you 12%, maybe more, maybe less. This is where you kind of investing is become kind of a necessity in this kind of economy where inflation is high. Your prices are going up much higher than how much your FD can return you. So that is why having kind of market linked returns is very important. That risk is kind of justified. If you invest for a 8-year or a 10-year horizon, there is a very good probability that your MFs can help you generate good amount of wealth. Nifty index fund is suitable for whom? So there are different types of mutual funds. There are index funds, there are large cap funds, there are mid cap funds. It will depend on your risk appetite and on your goals, sir. So you can kind of feel free to contact us. We'll put our contact information in this slide as well. So we can help you judge what kind of mutual fund suits you. How to bring bank bonds? I think so. Bank bonds are also kind of a decent kind of investment, but the only thing is bonds will be taxed at your tax rate. So let's say if you belong to the 30% tax rate, you'll kind of be taxed at that rate. I can get you more information on bonds as well. We have a separate team for it.
So my son is aged 12 years and daughter is 9 years. What kind of insurance should I take? I have a HDFC Optima health insurance plan for the family for a good amount. So additionally, what I would recommend is hope you have a separate individual term insurance and your children are the nominee for it. Yeah, that would be one thing. So if you are an earning member, then having a separate term insurance would make sense. Sorry, Nakul, you're on mute.
If you guys do have any other questions, please post them in the chat. We'll be happy to answer them as well.
So also for the coverage value about the health insurance and everything, you can actually get in touch to our insurance team. We'll be happy to help in that too.
Can you arrange a webinar about health insurance? We actually had a webinar covering health insurance today, ma'am. I'll be happy to, send you the recording of it so that you can listen to it as well. If you do want to speak to our insurance team, I'll be happy to, put you in touch with them as well. I'm paying LIC for 5 years. Can I stop to switch to term or can I stay on LIC? Sir, this is highly dependent on the kind of policy that you're kind of going for. So, we'll be only able to guide you if we know what kind of policy that is. So please get in touch with us after the session. We'll be happy to help you out in that regard. Thank you. Please send the health insurance. Yes, sure.
I will send it to you across. Also, one thing is we have a ithought advisory YouTube channel and all the live webinars conducted would be posted there too. So yeah. So I'll text you directly, sir, on Teams. Then you can just share me your mail ID. I'll send the webinar.
Yeah.
If anyone has any personal queries or doubts, you can directly reach out to us also. We'll be happy to address the same.
Is gold MF also good? Gold is a pretty good asset class, sir. So, if you do want to buy gold through the MF route, that is also possible. So, do get in touch with us. We can help you out with that as well, because it primarily depends on, how long you want to invest towards and what is your goal that you want to invest towards. Is it better now to sell all stocks and buy large cap mutual funds? So we'll be happy to talk to you and help you review your portfolio before you take that decision. We have an in-house team who can review your equity stocks as well as your mutual funds. So please don't rush into any decision.
What kind of corpus, some approximate amount one should have to retire and live upper middle class life? My current age 40, my monthly family expenses say 2.5 lakhs today. So actually, for this, our simple rule is whatever your annual expenses and the life expectancy we can assume to be 80 to 85 years of age, we can just multiply into 30 and we can figure out the whatever the wealth corpus is required. But one thing people miss out is not considering inflation in planning out your monthly expenses. So right now, obviously your 2.5 lakhs won't be valued the same after your retirement. So for this, we'll have to do the calculation and sure we'll be happy to help you out figuring out the estimate corpus required.
Is it better to add riders for health insurance policy? So there are specific type of riders which do well, sir. So for example, something like a restore benefit where, let's say your policy gets depleted. If you do have a restore benefit, all of the sum assured of the policy, let's say it's a 10 lakh policy, all of it gets restored as well. So there are some riders that do pay off well. My insurance team would be better suited to, take you through the specific aspects of each rider before we go for it.
I'll be dropping their contacts too on the chat. Nakul, there's one question.
Yeah. After how much amount invested in mutual fund, one should go for a PMS product. So this is very subjective. PMS is also kind of a mutual fund kind of thing, where we with our PMS we apply our own flavor to it, our own management style to it. That is something that Shyam sir's own style to it. So who should go for a PMS product is very subjective, sir. So of course the minimum limit is 50 lakhs. Let's say you have a crore or a two, you want to park a 50 lakhs in it. I think that should be good. Thank you for very influential. Thank you guys for joining and giving us the opportunity to kind of talk on it. My colleague Vinayak has posted all the relevant numbers in the chat. Kindly do make a note of it. For 40 years old, how much percentage ratio will be in debt and equity? I think if you're 40 and let's say you want to retire by 55 or by 60, I think having a larger portion towards equity as a thumb rule is good, but it will depend on person to person, because you might be someone who can take a lot of risk. I might be someone who doesn't want to take that risk, even when I'm not so close to retiring. So this is something that will depend on person to person, but I would say something like an 80-20 or something like even a 90-10 should do good. Because what most people do ignore is that you're already contributing to debt in the when EPF gets deducted out of your salary, that is already forms your debt portion. Thank you, Mr. Damodar. Thanks for your time on this lovely Saturday evening as well. Okay, if you guys do have any other further questions, please do post them in the chat. For long-term investment, which one will good in terms of compounding MF for individual stock investment? So what we've usually seen is that for people who are starting out, mutual funds are a better way to start out, because you have a job, I have a job. So it's often, kind of difficult to research these stocks, year in, year out, day in, day out. It is kind of difficult, right? Whereas in a mutual fund, yes, it is important to pick the right mutual fund. And they kind of take care of the professional management. While individual stocks can be a very big hit or a miss, mutual funds kind of they can perform, higher probability of them performing consistently over time, because it is managed professionally. Right? So for people starting out, I think MF is a good kind of investment. Will your team help in suggesting my equity portfolio for a fee? So please do contact us, sir. We'll see how we can help you out on this. My colleague has posted all the relevant numbers in our chat, so you guys can make a note of it. We'll be happy to get in touch with you and answer all your queries. If you guys have any further queries, please do post them in the chat. We'll be happy to answer them as well. Can we use MF utility to invest in mutual funds? Yes, MF utility or MFU is a platform where I think you can invest in mutual funds. But again, I do want to make the important that make a point clear is that there are a lot of mutual funds available in the market, and there are mutual funds which underperform as well, which do take undue risks as well. So choosing a mutual fund is as important as choosing a right stock.
So I guess we can wind up. If
Yeah.
anyone has another further doubts or queries, you can directly reach out to our contact. And thank you all for joining in for Saturday evening session. Hope it was insightful and informative. Thank you.
Thank you. Thank you, guys. Have a long weekend as well. Bye-bye.
Yeah.